Okay, I'm coming to you today with a couple of products that I want to educate you on. I'm going to make this video short. Please grind through this. I appreciate you watching. Okay, first thing I want to talk to you about is non QM. A qualified mortgage meets six pieces of repayability. A non qualified mortgage does not. It's a private sector of loans, it's relatively new, but I've been doing a lot of them the last 12 months. Some quick highlights. We can qualify borrowers to buy investment properties off of the property's income. So that's via the appraisal. We could do bank statement loans. I could do variances in W 2 income to 1099 without having to wait 2 years. The qualified mortgage market is pretty vanilla. The non qualified mortgage is sort of filling that gap for borrowers that deserve mortgages but typically can't get them from the regular mortgage product. Without going too deep, think of me when you think investment property and it doesn't quite fit. Chris can probably do it. Okay, so we have a market that's still doing well, but we also have a market where certain pieces of inventory they're sitting a little longer, which might be creating some difficult conversations between you and the seller. So, list and lock. So, this is where it gets salesy and gimmicky, but this is actually a pretty nice option to present a seller that might be unhappy about their house not selling at the moment. A seller hops onto my website. They make a choice to pay 1, 2, or 3 points at the closing. CMG throws in one ourselves. What happens is we take that and we lock all of the interest rates available in every mortgage product below market because of the points being paid. So what does that mean? What's the mechanics of it? Well, we start marketing those below market interest rates on your listing. We give you sign riders, we create marketing, we have single sites that we put up. Basically, a buyer comes in, if they qualify for it, we will give them the below market interest rate. I guess that's the incentive. And so the mechanics of it is instead of dropping your asking price, let's market a below market interest rate. Maybe we can entice some buyers. Maybe we could get that under contract and we could get that seller to settle down and be happy. List and lock, ask me about it. Before I tell you about the last two, I know we have attention spans these days that are like this big. Keep grinding. I have two more quick ones to tell you about. GoFundIt. So, what is GoFundIt? You're familiar with GoFundMe. So, this is a website platform where people can make donations to it. We normally see it when people are going through a hardship. We have GoFundIt. So, what the mechanics are is a borrower will go on our website, they'll apply for it, they'll tell us a little bit about themselves. We will push out a web page that allows people to donate to it, and they can use those funds immediately for a down payment for a purchase. So we create the marketing. If they share it a certain amount of times, we also make a donation into it. So I like this for the borrowers that are getting married. That's an example of it. Have the borrowers send this out in the registry. People click on it, they make a donation. Those funds are immediately available for housing down payment. The mechanics of this, typically people that are not related cannot provide down payment monies as a gift. This program allows it. So think about it for people getting married. I don't have other examples because the married thing is typically the best one, but go fund it. That's a good one. Ask me about it. Last but not least, and I think this is a big one in your market because we have sort of a tier of borrowers that I think are in a class purchase price wise that benefit for this mortgage product, all in one. So we basically give a borrower a line of credit that's attached to a checking account. It's a sweep account. So a borrower has to pay their mortgage once a month. That borrower attaches a deposit into the account. It immediately sweeps. So it's an immediate payment and principal reduction. Every month that a borrower makes a payment, it increases the equity. Standard, right? Nothing surprising there. If that borrower wants to tap into the equity after the fact, let's say they need a furnace, they want to buy another property, whatever. Kids need braces. I could keep giving random examples. They could actually write a check from that account. So we call it the all-in-one loan: primary residences, second homes, investment properties, jumbo loans. Think about this loan for the psychopath that likes paying down their mortgage quickly, but also likes the functionality of being able to use that equity after the fact. So thank you for watching. I know the video gets a little lengthy, but these are some of the products that I'd like you to know about. If you have any questions, reach out to me, please.